Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Tavi Costa, partner and portfolio manager at Crescat Capital.
Hey,
Welcome
thanks
back,
for
Tavi.
having me, guys. Looking forward to this.
It's always a pleasure having you on. Everyone's talking about the yield curve lately, but the Fed seems to be they keep on taking us into a recession. This doesn't make sense to people. Can you explain to our audience what you're thinking, Tavi?
Look, we've seen this type of monetary tightening before, but not at a time when you have these levels of inversions in the yield curve. I mean, in this chart, you're just looking at 2 versus 10s, but we looked at it in a much more comprehensive way, and you can see that about 40% of all possible spreads in the yield curve are actually inverted. This is an important signal because usually it tends to precede a recession or a downturn in the economy. And that tends to also cause the Fed to either pause its rate hikes or reverse its policy. And so the only time we actually have seen this level of yield curve inversions along with Fed tightening was in 73, 74. And that was a time when we saw an inflationary recession. I think we're headed towards something along those lines. I mean, it's scary to see the Federal Reserve becoming more and more aggressive over time here at a time when we're also seeing the economy completely falling off a cliff. So I'm quite worried about where the economy is going to be 6 months from now. And I think it's going to be in a very tough place.
Tavi, this is the Fed funds rate, and you can see just over time through each cycle, they've been able, lower highs has been the trend. As the debt has accumulated, both the public debt and corporate debt levels have gotten larger, personal debt levels have gotten huge. The Fed has less and less room to raise rates higher in each cycle before a recession happens. And the Fed's raising rates this week, and we're going to be back at that same level of the last one in 2018. What's your sense here? Is like the Fed? Do you really think we're going to get significantly higher than the previous peak right here from a couple of years ago, or are we already maxed out in where the Fed can go here in terms of hiking rates?
Well, I think we're at the late innings of a hiking cycle, but the reflection of this chart of the Fed funds rate making lower highs is certainly is a reflection of the debt spiral that we're in here in the U.S. I mean, it's what we call the trifecta of macro imbalances. We have the debt problem of the 40s, the inflation problem of the 70s, and the valuation problem. Not a lot of people talk about that, but risky assets are extremely overvalued still retesting levels that we saw in the tech bubble. And so it's hard to believe that the Fed can really do a lot, right? And we all know that the Fed is, in a way, boxed in with those imbalances that really create a lot of constraints politically for them to react. So ultimately, I think the Fed is going to pick the inflationary route, which is inject liquidity into the economy at an inflationary environment. But we're not there yet. So we're seeing this hawkish stance in an environment that is, as we're also seeing the economy falling apart. And so I think this is just the beginning. You got to be looking at the margin and leading indicators. If you look at ISM manufacturing, PMIs at the worst level since the global financial crisis. You saw CEO confidence falling apart, the largest departure of CEOs in 20 years. Over 700 CEOs have left their roles in the last 6 months. And so it's hard to believe that they don't know something that we don't know. At least the average person doesn't know. And so it's a little scary. I think we're going to be in a very tough place, and it's going to reflect in labor markets very soon.
Well, Tavi, I just want you to know there's not going to be a recession. Yellen sees no signs of a recession at all coming. We have been assured by the administration that there are no signs of a recession, and I don't know where you're getting this. So just so you're aware, all the top names in the government disagree with you passionately, just so you're aware. But what you were just saying, China consumer confidence, this is one that you just tweeted out a couple of days ago. I thought it was really interesting, so I wanted to put this on the screen. This is huge. China's a huge piece of the economy right now. And this leads into all commodities too, right? Copper, everything that China imports in the commodity stream.
Absolutely. I mean, China is in a balance sheet recession. I mean, it's highly indebted, just like most developed economies too. But it's still, call it an emerging market, maybe not an emerging market anymore, but certainly is highly indebted from a real estate part of the economy, but also from a banking side as well. It's extremely levered. And we know that for a fact, and we've been very concerned about China for some time now, and we think it's going to reflect in a depreciation of the currency. And it's a very contrarian view. I think a lot of people think the opposite. But in my view, it's, what's happening in commodities, especially cyclical ones, where we saw this decline in copper prices and even oil as well, is a reflection of how the demand is going to look like in the near future. And this chart right there, I mean, the consumer confidence, who knows? This is a government data as well, and it's Chinese government data, so it's, gives you even less credibility of what the validity of this data in a way. But I mean, following China very closely over the years, I've seen so many indices come and go, right? I mean, indices that they used to track, they're not tracking anymore. They just stopped tracking it. Or there used to be one that used to look at economic activity through satellite images and so forth, and that one is gone. I mean, it's just, we haven't seen that since 2015 or so. Once
the measure the lights at night or something like that to try to determine electricity consumption growth or something like that.
I mean, people keep coming up with different ways to measure the declines in economic growth in China and the issues in China. And every time you see things really deteriorate, they come up with a new policy to remove those data points from the availability for investors to see it. And so who knows, maybe someone just got in trouble for reporting that, or maybe they want you to see it. There's investors in all fronts, but the truth is that they are facing a balance sheet recession right now. Balance sheet recessions take a long time to play out. We've had Japan facing one in the late 80s and early 90s, and took a long time for Japan to go through all that. And it's still facing the issues right now with the Japanese yen falling apart relative to the dollar, relative to gold. So those are issues that take a long time to unfold. And I think we're seeing that in China now.
Well, I think this chart that you tweeted out back about a week ago on the 22nd, I wanted to pull this one up because this goes back and looks at it long term. You're looking back here at the 73-74 recession, which I guess was the last big parallel for when we had huge inflation in our economy, was that back during that recession. What's the key point that you're trying to make here in terms of what we should be paying attention to as investors?
Well, number one, inflation happens through waves, and we have probably seen most of the first wave of inflation here. And I could change my view if commodities, go even higher from here in the next 3 months. Certainly, the first wave is still in place. But in that first wave of inflation, what you tend to see is now a change in policy from the Federal Reserve that causes risky assets to fall apart. And then you start seeing the corporate margins and fundamentals completely deteriorate, which I think it's still kind of unfolding depending on the industry. We're starting to see guidances already also be a lot lower than expectations. And so you start seeing that reflect in prices. And so the re-rating of valuations now happening in equity markets is important. It took about 48% decline in equity markets back in 73, 74 to then start seeing inflation or CPI, government data start going in a downward trend. But that only, was only a 2 to 3 year downward trend. Then we saw inflation come roaring back in the late 70s. And so inflation's out of the gene. So this whole idea that, we may see a deceleration, sure, we could potentially see a deceleration of inflation, but any sort of injection of liquidity that we see here is going to immediately cause inflation to get back to the levels that we've seen, if not higher levels. And so given the political constraints that we have in the macro imbalances, it's hard to believe inflation will stop here from growing. So I'm very concerned we're in the inflationary environment, and that's why I think we should be owning a lot of tangible assets in this environment.
I actually went back and looked at what happened back during the 1974 recession. And you're right, as soon as we came out of that recession, okay, we were at like 9% inflation going into the recession. There was a recession in 74 that did bring down inflation to like 5%. But as soon as we exited the recession, the rest of the 70s, it was boom, 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 boom. We're up to 12, 13% inflation within a couple of years after that. But, everyone thinks it was Paul Volcker raising rates that killed it. You know what also happened in the late 70s?
Hmm.
The Alaskan pipelines started producing, and offshore Gulf of Mexico oil started scaling up dramatically. So it wasn't just the interest rates of Paul Volcker that killed inflation. It was a massive influx of fresh energy supplies that probably was a big help also in that process. And so if that's accurate, you got to ask yourself, what's the new source of energy or commodities that's gonna stop the commodities boom, or that's gonna bring prices back down? And I don't know if you've given any thought to that.
No, I do. I mean, I do think that what you're saying is extremely relevant. I mean, a lot of people are looking back with the declines in, especially in consumption, perhaps, and so forth, and comparing this with '08. But '08, we did see a very large amount of investments coming into the natural resource industries. And the whole commodity cycle is predicated on the CapEx cycles. And right now we're nearly probably at about 19 to 20-year lows when adjusted to GDP levels. And I agree with you. And it's, the availability of credit, availability of capital right now is very difficult with the monetary tightening. It's not helping to fix that. And so the structural part of the thesis, which has to do with the CapEx trends, have not been resolved. And so how in the world are we in a peak market for commodities right now when we haven't really seen that, aggressive investments coming into the space with a lot of capital allocators swimming around the natural resource companies and so forth. We haven't seen much of that.
Yeah, no supply response at all, really, to that's bringing anything new to the market in many commodities. It's not just silver, it's not just gold. It's across the spectrum in the commodity space. You just haven't seen the supply response, right?
Well, the commodity space is almost dead in terms of, it's not just the political effort against it, but it's also coming internally. I hate to say it, but if you look at Newmont inside purchases of stocks from inside of their companies, we haven't seen one single purchase from those guys in 7 years. One single purchase.
I wasn't aware of that.
Internally, yeah. I mean, internally, there's an issue in the industry overall, right? I mean, this is not just happening, or in general, we're seeing financial engineering happening in most companies today in the US. It's not just natural resources where they've been buying back their own shares, right? We've seen a lot of buybacks recently. Right. So about just in the last 12 months, if you look at the top 100 companies in S&P, 98% of their cash flow was used to buy back shares. That is 4 times what they spent in their own businesses through CapEx. And then you think, oh, great, they're buying back their shares. I'm sure their companies are actually performing very well. No, they have outperformed by 0.8% the equal weighted S&P 500 in the last 3 years. I mean, that's insane. Yeah. So there's a lot of issues under the surface happening here.
Well, so I put up this next one. This one you tweeted. This is, over a week old, from July 19th, but it was really good. This is going back to 2006. This is a major trend change.
It's in my view, it's the beginning of a bull market for commodities. That is, sure, we can get some issues cyclically speaking because of the fall in demand and issues with economy and the hiking cycle that we are in most developed economies. And we may see some problems with, corporate margins declining in most companies, and employment may not be as strong. I don't think will be strong at all in 6 months from now. And so those issues may actually reflect in weakness in commodities. But as a capital allocator, I think this is a gift. I think you want to be looking for ways and inefficiencies in those markets to really allocate capital over the next 5 to 10 years. It's going to be, most of companies are facing a supply cliff. When was the last time we've seen discoveries of copper or silver or gold in the last 10 years or so? New discoveries. I mean, it's been a long time, especially base metals that we need for the green revolution that is so, everyone talks about. And so I think this is going to be, it's going to be a transition. It's part of the value growth shift that we're seeing. A lot of commodity business are profitable and are part of this environment where we haven't seen a lot of flows of capital coming into the space. More of those have been chasing technology and growth stocks. I think we're seeing those shifts happening all at once. The 60-40 portfolios. I mean, everything is hitting all at once. And I think that shift into commodities is just at the beginning. So to me, it's a major focus for our firm. And we want to be in the forefront of the investments in the precious metals and base metal space.
Yeah, just another thing I think we should be aware of, the definitions are changing for everything. So just be aware, no matter what happens, unless they agree that the definition is accurate, it didn't happen. All right. So there's never going to be a recession again, at least until the Republicans are in control. Then we're allowed to have a recession again. Just so you're aware, that's the new definition.
And Jim, you know what's coming, right? They changed the definition of recession. The next one is going to be the definition of the 2% inflation target. Yeah. We're going to talk about that very soon here because that inflation target is way off. And I want to know what's going to be their target for unemployment rate in 6 months from now, because that's going to be a problem here.
Oh, they're going to change the definition of unemployment. If the rate actually starts going up for unemployment, it's going to be no, you're not unemployed. You're just on vacation. Or I don't know what it's going to be, but you're on extended leave without pay. It's like, why can't they just have the courage? Just remember back 20. You're too young, Tavi. But remember back 20 years ago, it used to be okay. It used to be okay to have a recession. Everyone's like, all right, we're gonna have a recession. It's time for the bad companies to die and go bankrupt and creative destruction, and those were all just understood parts of the cycle. Now, what's so wrong with having a recession and just own it, admit it? Get through it, and then we have the happy time afterwards, right?
Yeah, it's a tough environment where we're seeing with policymakers and the changes in geopolitics, and inflation is such a strong trend. I mean, coming from Brazil, I've seen so many changes of political environment and leadership caused by inflation. And I think developed economies are about to face that here too. And so it's hard to believe that most of the political leadership in developed economies won't be shifting, given the fact that inflation is such a big problem. Inflation is usually the worst enemy of any political figure. And so it's a big problem in leadership, obviously. And so I think we're going to see some big changes across the globe, and probably facing something very similar to the fourth turning idea. Now, that book has completely nailed what's happening here in the overall geopolitical environment.
Tavi, you are just so much fun to have on. I mean, you got the best graphs on Twitter. I encourage everyone, follow Tavi's account. I'm going to put the link to Tavi's account in the description. He's a blast to follow on Twitter if you have a Twitter account. And we love having him on here on our channel. And we're going to do it again in 2 or 3 months, man.
It's my absolute pleasure. And thanks for having me again, guys. I always enjoy talking to you.